Elon Musk just agreed to a compensation deal so extreme that most people who read the headline assumed it was satire. He gets paid only if 1 million human beings are living permanently on another planet. Not profits, not quarterly earnings, not even a stock price target you could track on a screen. A civilization on Mars. And if it doesn't happen, he receives absolutely nothing. Now, pause on that for a second, because this isn't a headline from a tabloid. This was disclosed in a confidential registration statement filed with the Securities and Exchange Commission. It was reviewed by Reuters and reported on April 28, 2026. This is real. But here's the part that almost no one in finance is connecting right now, and this is exactly why I'm making this video. This deal doesn't just affect SpaceX. It reaches directly into Tesla's stock, into the AI infrastructure race, into the upcoming IPO market, and into how capital is going to move over the next 12 to 24 months in ways that most retail investors simply aren't positioned for. Quick disclaimer before we go further, nothing in this video is financial advice. I'm breaking down publicly available information and market dynamics to help you think more clearly. Always do your own research and consult a qualified financial advisor before making investment decisions. If you're new here, this is the Market Continuum, where we track the shifts most people see too late. Hit subscribe if you want to stay ahead of the curve, not behind it. And stay with me until minute 13, because that's where I'm going to show you something about the space economy and AI compute that almost nobody is talking about. And it has the potential to be one of the most significant capital rotation signals of the decade. Let's get into it. The SpaceX board approved this compensation package in January of 2026. It was structured around 2 separate awards, both tied to milestones that have never existed in any CEO pay package in corporate history. The first award, 200 million super voting restricted shares if SpaceX reaches a market valuation of $7.5 trillion and establishes a permanent human colony on Mars with at least 1 million residents. The second award, up to 60.4 million restricted shares if SpaceX meets separate valuation goals and operates space-based data centers delivering at least 100 terawatts of computing power. Let me be direct about the scale of what we're discussing. 100 terawatts of compute capacity is equivalent to 100,000 1 gigawatt nuclear reactors running simultaneously. That's not a goal you see in a corporate filing. That's something you'd expect to find in a government energy policy document. And yet, here it is, in a registration statement, for a company that is currently preparing to go public. The structure means Musk receives nothing unless those milestones are reached. No timeline is attached as long as he remains with the company. This isn't a conventional hit your targets in 5 years arrangement. It's open-ended, civilizational in scope, and entirely without precedent in the history of executive compensation. Corporate governance experts, cited by Reuters, said they had never seen anything like it, because they hadn't. Now, here's where it gets interesting for investors, and slightly uncomfortable. Where are you watching from? Drop your city in the comments. I want to know who's paying attention to this story around the world, because what's happening right now cuts across every major financial market on the planet. Let's put $7.5 trillion into proper perspective. As of today, April 29th, 2026, the largest companies in the world are valued at roughly $2 to $3 trillion. Apple, Microsoft, Nvidia, the companies that define the AI era, 7.5 trillion would be more than double the current valuation of the most valuable company on Earth. And SpaceX is currently valued, ahead of its IPO, at approximately $1.75 trillion. So the compensation target is asking the company to grow by more than 4 times its current value, after building orbital data centers and putting 1 million people on another planet. So the obvious question is the one investors rarely ask out loud. Is this genius, or is it a narrative designed to make an IPO irresistible? Because here's what the markets understand that most people don't. It doesn't actually matter whether Mars gets colonized in 10 years or 50. What matters is that the story is big enough and bold enough and attached to a name powerful enough that capital will flow toward it regardless. And capital that flows changes prices. Stay with me, because the next part is where this becomes directly relevant to money you might already have in the market. Let's talk about Tesla. Tesla's stock is currently trading around $376 per share as of this week. It has dropped approximately 14% year to date. It missed revenue expectations in the first quarter of 2026, bringing in $22.39 billion against an expectation of $22.64 billion. And on the earnings call on April 22nd, Musk announced that capital expenditure this year would exceed $25 billion, a number $5 billion above prior guidance. The stock gave back its initial earnings bump almost immediately. So here is the tension that Tesla investors are sitting with right now. The core automotive business is under pressure from global competition, particularly from Chinese manufacturers like BYD and Xiaomi, whose vehicles are priced at roughly half of Tesla's comparable models. EV sales remain the bulk of revenue. The Cybercab and robotaxi expansion are real, but not yet generating meaningful income. The Optimus humanoid robot program is compelling, but still months from any commercial ramp, with Musk indicating late July or August of 2026 as the earliest meaningful update. And now, layered on top of all of this, you have the CEO of Tesla personally committed to a mission that requires him to put 1 million people on Mars. Comment below if you think Musk's focus on SpaceX will hurt Tesla's near-term execution. I read every comment on this channel, and this is genuinely one of the more consequential questions in markets right now, because the concern isn't just abstract, it's structural. Think about what governance experts are actually pointing to when they raise concerns about this package. It's not the Mars goal itself, it's the conflict of attention. Elon Musk is currently the CEO of Tesla, the CEO and CTO of SpaceX, the owner of X, the founder of XAI, which SpaceX acquired in February of 2026 in an all-stock deal, and the head of the Department of Government Efficiency under the current administration. That's not one job. That's not even 3 jobs. That's an entire ecosystem of conflicting demands on a single human being. And now, his personal compensation at SpaceX has been tied to outcomes that are so vast and long-term that they will require decades of focused execution. 2 companies, Tesla and SpaceX, are now formally competing for the same resource, his attention. Markets hate uncertainty, especially leadership uncertainty, and especially when the leader in question is the single reason millions of retail investors hold a stock. Tesla's market capitalization sits at approximately $1.45 trillion as of this week, 5 times larger than Toyota, the world's best-selling automaker. That premium is almost entirely built on belief in Musk's vision, not on the current price of the cars, not on current free cash flow, on vision. And vision is the most fragile form of a stock's foundation, because it can disappear overnight. But here's what they're not telling you, and this is the part that will determine which side of this trade you want to be on. There's a genuinely bullish case here, and it's stronger than the headlines suggest. This compensation structure does something that most CEO pay packages never achieve. It eliminates short-term thinking completely. There are no quarterly earnings targets embedded in it, no annual revenue milestones, no share price triggers that incentivize buybacks to hit a number before year end. The only way Musk gets paid at SpaceX is if he builds something that reshapes human civilization. That's either completely delusional, or it's the most powerful alignment of incentive and mission ever constructed in the corporate world. And consider what markets have rewarded over the last decade. They didn't reward incremental earnings growth. They rewarded narrative. AI was a narrative. Electrification was a narrative. The cloud was a narrative. Every trillion-dollar company of the last 15 years was, at its core, a story that became too big to ignore. Space is the next narrative, and it has something that AI never had in its early years, a single globally recognized face at the front of it. Hit like if you think the SpaceX IPO is going to be the biggest financial event of 2026, because I think it might be. And I want to show you exactly why. Let's talk about the IPO itself, because this is where things start to get very real for ordinary investors. SpaceX is currently preparing to go public around June 28th of this year, coinciding with Musk's birthday. The targeted valuation is approximately $1.75 trillion. The company is aiming to raise roughly $75 billion, an amount that, if achieved, would surpass Saudi Aramco's record offering from 2019. The IPO will use a dual-class structure. Musk and top insiders will hold Class B supervoting shares carrying 10 votes per share. Outside investors will hold Class A shares. This is the exact same model Musk has said he wished Tesla had adopted back in 2010. He's building it into SpaceX from the ground up. What does this mean in practice? It means that even after going public, Musk will have nearly unbreakable control over the company's direction. The board cannot easily move against him. Institutional pressure is neutralized, and the long-term vision, however extreme, is structurally protected from the short-term demands of public markets. For some investors, that's a governance red flag. But for investors who believe in the direction, it's a feature, not a bug. And there's one more layer here. SpaceX recently acquired XAI, Musk's artificial intelligence company, in an all-stock deal that created what he described as a vertically integrated innovation engine. The combined private valuation following that acquisition was approximately $1.25 trillion. That was before the current IPO valuation estimates. In other words, the AI component is already baked in. This isn't just a rocket company going public. It's a space, AI, satellite, and computing conglomerate preparing for the most anticipated public offering in a generation. Stay with me, because what I'm about to show you about the compute angle changes the entire frame of this story. Let's go back to that 100 terawatts figure, because most financial coverage of this story glosses over it entirely. And it's arguably the most important number in the whole package. US data centers are projected to consume 470 terawatt hours of electricity by the year 2030. The constraint isn't demand. The constraint is supply. Power grids, land availability, cooling infrastructure, regulatory delays for construction. On Earth, building AI compute infrastructure is slow, expensive, and politically complicated. But in space, there are no zoning laws, no NIMBY resistance, no grid congestion, no water usage concerns for cooling systems. And here's the part that sounds absurd until you really think about it. The energy available in space from direct, unfiltered solar radiation is approximately 8 times more powerful per square meter than what reaches Earth's surface after passing through the atmosphere. The physics of space-based solar power are real. The engineering challenges are enormous, but they're engineering challenges, not physics impossibilities. So when SpaceX's compensation package ties Musk's awards to operating data centers in space, delivering 100 terawatts of compute power, what they're actually saying is, we believe the next frontier of AI infrastructure is orbital. Now ask yourself, which companies benefit if that happens? Which sectors see capital inflows? What does that do to the current AI infrastructure trade? The chip makers, the data center operators, the power generation companies? This is where it gets really concerning for investors who are positioned in yesterday's version of the AI trade, and really interesting for those who are willing to think one step further ahead. Let me break down the market impact as I see it right now, with the information we have as of this week. For Tesla, in the short term, the picture is complicated. The stock has underperformed every one of its mega-cap technology peers so far this year, down around 14% year to date, with a 52-week high of $498.83 and a current price around $376. The business fundamentals are actually improving. Operating income surged over 135% year over year in the first quarter. Automotive gross margins expanded from 16.2% to 21.1%. Free cash flow was up dramatically. These are not the numbers of a failing company, but sentiment is fragile. And sentiment, not fundamentals, drives near-term price action in a stock that trades at close to 200 times forward earnings. The risk here is not that Tesla goes bankrupt. The risk is multiple compression, the slow erosion of the premium investors assigned to the Musk vision story, as his attention increasingly migrates toward a $7.5 trillion target on another planet. You need to understand this before we move to the next part. There is a scenario where Tesla's business improves and the stock still goes sideways or lower. That scenario is called narrative dilution, and it's already beginning. For the AI and chip sector, the SpaceX story is broadly bullish. 100 terawatts of compute demand, even if it takes 15 years to build, anchors the long-term investment thesis for semiconductor companies, power management technologies, and data infrastructure providers. The demand signal doesn't need to be immediate to move capital. The anticipation of demand is enough. And for the space sector specifically, satellite communications companies, launch service providers, orbital infrastructure plays, what SpaceX is disclosing in its registration statement is essentially a roadmap for where the next generation of capital-intensive industrial investment is headed. The companies that can participate in building that infrastructure, whether as partners, suppliers, or competitors, are worth paying attention to now, not after the IPO headlines. Share this video with someone who manages their own portfolio. Because the SpaceX story is being covered as a curiosity on a Musk does crazy things narrative, when it's actually a structural market signal. And then there's the merger question, because this story doesn't end with the IPO. On April 27th, 2026, just 2 days ago, Wedbush Securities Managing Director Dan Ives stated publicly that he sees an 80 to 90% probability that Tesla and SpaceX will merge by the first half of 2027. His reasoning is that the two companies are already operationally intertwined. Tesla has converted its $2 billion XAI stake into a direct ownership position in SpaceX through FTC-approved filings. The joint Terafab chip facility is already in development. The AI and autonomy roadmaps are converging. Ives described the combined entity as the best physical AI play in the world, a company that would span electric vehicles, humanoid robotics, satellite communications, autonomous driving, and orbital computing under a single corporate umbrella. Not everyone agrees with the framing. Ross Gerber, CEO of Gerber Kawasaki Wealth Management, publicly stated on X that what Ives is calling a merger might look more like an acquisition, SpaceX absorbing Tesla at a point of weakness, rather than two equals combining at a point of strength. That disagreement tells you something important. Even among sophisticated market participants, there is no consensus on whether this is a story of creation or consolidation. whether Tesla is the engine of the future or a legacy asset being restructured into a larger machine. And right now, in late April of 2026, no one knows which interpretation is correct. So let's run the scenarios, not with false certainty, but with honest clarity. Scenario 1, it works. SpaceX goes public in late June at approximately $1.75 trillion. The IPO is oversubscribed. Retail FOMO is historic. Mars, $7.5 trillion, Musk, and institutional money follows narrative as it always does. The combined SpaceX and XAI entity begins demonstrating real progress on orbital compute infrastructure. Starlink's subscriber base, already past 10 million customers in 160 markets with over $10 billion in annual revenue, continues to expand. The Tesla merger materializes in early 2027. The combined company is positioned as the defining technology conglomerate of the next 20 years. In this scenario, early investors in SpaceX are sitting on one of the most significant generational returns in market history. Tesla stock recovers as the merger premium gets priced in. The AI infrastructure trade rotates from terrestrial to orbital, and the $7.5 trillion target starts to look less like a fantasy and more like a directional forecast. Scenario 2, it doesn't. The IPO happens, but the SpaceX premium is built on a narrative that reality can't yet support. The orbital data centers remain theoretical. Mars remains a two-generation timeline. The management conflict between Tesla and SpaceX becomes visible in quarterly results. Missed deliveries, delayed robotaxi rollouts, Optimus timelines that keep slipping. The supervoting share structure prevents any corporate course correction because governance power is entirely concentrated. Tesla investors, who already paid a 200 times forward earnings multiple for a vision that's now being split between two companies, begin reassigning that premium downward. In this scenario, the capital that flows into SpaceX at IPO doesn't disappear, but it doesn't compound the way the story promised. And Tesla shareholders who didn't sign up for a Mars mission find themselves holding a position that's simultaneously attached to the most ambitious corporate narrative in history and unable to benefit from it directly. Here's what I want to leave you with. Something is shifting. Most people are looking at the SpaceX compensation story as an Elon Musk personality story, another chapter in the long-running saga of a man who does things no one else would do. And there's truth in that reading, but it misses the more important thing. The structure of this deal, the governance design, the IPO mechanics, the merger speculation, the orbital compute ambitions, is a window into how the next generation of capital formation is going to work. We are moving from an era where companies competed for market share into an era where companies compete for civilizational relevance, where the biggest investment narratives aren't tied to quarterly earnings cycles, but to decade-long missions, where the executives with the most ambition don't just build products, they build the infrastructure of entire new industries. That is a fundamentally different investment environment than the one most retail portfolios were built for. And it's already here, not in 10 years. Right now, in late April of 2026, in a registration statement filed with the SEC, in a pay package tied to the survival of humanity on another world. The question isn't whether you think Musk can pull it off. The question is whether you understand the market dynamics that this story is setting in motion, and whether you're positioned to navigate them. That's what the market continuum exists to do, not to tell you what to buy, to help you see what most people aren't seeing yet. Drop your thoughts in the comments. Tell me which scenario you think is more likely, and why. And if this video made you think about something you hadn't considered before, share it with one person who needs to see it. That's how independent financial analysis survives in a world built on noise. I'll see you in the next one. Stay sharp.